A paycheck may increase, but the month often ends with little to allocate for future growth. Bills, minor upgrades, and unexpected purchases quickly consume any raise before a long-term plan can take shape. This occurs because focus shifts to perfect timing and ideal choices, rather than forming consistent buying habits. The real factor is how frequently surplus turns into assets, rather than how smart a single decision seems. Without a reliable system, saving feels like an uphill battle, and investing seems like an uncertain leap. Over time, this indecision stunts compounding and turns financial progress into a task influenced by emotions. A 23-year-old might have just $1,000 invested, but still feels the urge to check balances daily. Spending hours analysing data might feel productive, but the account remains modest when regular investments aren't scheduled. In the coming minutes, this breakdown will clarify when to save, when to invest, how to spend, and how to maintain consistency. This video draws inspiration from Just Keep Buying by Nick Maggiulli, so make sure to subscribe for more evidence-based financial strategies. A helpful decision-making tool is the Save Invest Continuum, which evaluates the benefits of saving versus the potential growth from investing. It operates by comparing your future savings capacity with anticipated investment growth within the same time frame. When your saving capacity is larger, market risks may provide limited benefit and can cause stress as deadlines approach. Conversely, when growth potential is greater, sitting on cash often costs more than typical market fluctuations. A household saving for a home within a 10-year window should remain in cash, as a market downturn could jeopardize their plans. A household saving for several decades stands to gain from compounding, making consistent investing more advantageous than excessive saving. This approach shifts focus from trying to predict market movements to aligning financial decisions with your timeline and flexibility. It also differentiates short-term security from long-term growth, ensuring each financial goal has a clear purpose. Clearly articulate your goal, establish a deadline, and determine your monthly surplus. Then assess your saving capacity against projected growth using conservative estimates. If growth potential outweighs saving, automate your investments. If saving takes precedence, build your cash reserves until your target is achieved. Spending inflation means your expenses increase along with your income, often establishing a new baseline within weeks. A simple guideline is the 2x rule, which connects each discretionary upgrade to an equal investment contribution. Without this guideline, most income increases transform into fixed commitments, pushing long-term goals further away. Once more than half of future raises are spent, progress toward financial independence slows significantly. After a raise, many celebrate by dining out more frequently, upgrading their vehicles and purchasing larger homes. The next pay increase feels diminished, as the new spending baseline absorbs it before any additional investment can happen. Pairing each upgrade with a corresponding investment helps maintain enjoyment while simultaneously building assets that support future opportunities. This keeps the primary habit intact, as investing continues even when lifestyle changes feel justified. Select one meaningful upgrade, automate the corresponding transfer, and thoroughly review any raise decisions before setting up additional payments. As time progresses, you'll find yourself spending with purpose and increasing your investment contributions without relying on sheer willpower. Market timing may seem appealing since buying after a decline often feels less risky than purchasing at unpredictable prices. However, waiting necessitates making two precise decisions: when to exit cash and when to jump back in. Dollar cost averaging involves investing a consistent amount on a regular schedule, irrespective of alarming news or recent price fluctuations. This strategy succeeds because most long-term gains stem from time in the market, rather than attempting to catch fleeting lows. A saver who waits for a dip risks missing out on months of compounding, while prices continue to rise. Even when a dip occurs, indecision often delays the purchase, leading to an inconsistent and emotion-driven strategy. A more effective habit is to invest as soon as you have surplus funds and continue through market peaks, drops, and slow periods. This approach lessens the mental burden of decision-making, allowing the calendar to dictate purchases instead of daily emotions. Begin with one diversified fund, select a monthly contribution amount, and view each investment as a lasting asset. If this alleviates the stress of timing, consider exploring additional frameworks that can make your progress systematic and repeatable. Individual stocks come with company-specific risks, meaning one business can falter even while the overall market thrives. Diversification mitigates that risk by distributing ownership among various businesses instead of relying on a single entity. Evidence shows that outperforming a broad market index is incredibly challenging, with most professionals failing to achieve it. Returns tend to concentrate among a small selection of stocks, so identifying winners relies more on luck than skill. An investor might buy a few individual stocks hoping one will excel, but most choices end up stagnating or declining. In contrast, another investor buys an index fund and holds it, capturing significant winners without the need to predict the right ones. This strategy aligns with a broader investment philosophy, because consistent buying is more effective when your portfolio can weather mistakes and surprises. It also reduces the demand for constant research, freeing your time for earning, saving, and making intentional spending decisions. Select low-fee index funds, automate your contributions, and recognize that average market returns often surpass more complex strategies. Periodically review your results, rebalance as necessary, and focus most of your energy on the behaviors you can control. Debt isn't inherently negative, but it imposes fixed obligations that can amplify financial setbacks. Borrowing is justifiable only when the benefits are clear and the risks can be managed. One reason for leveraging debt is to lower overall risk, like maintaining liquidity for emergencies or job transitions. Another rationale is to generate returns when the expected gains exceed the cost of borrowing. Issues arise when debt fuels consumption, as payments persist even when the initial thrill is gone. High-interest debt also hampers your ability to invest, siphoning cash flow towards interest rather than assets. This connects to the larger financial picture, as consistent buying requires flexibility rather than the stress of monthly obligations. A practical guideline is to align each debt payment with income stability, emergency savings, and a clear payoff strategy. If the interest is high, make repayment a priority. If it's low, focus on building financial buffers and investing consistently. The aim is to achieve flexibility over time, ensuring that setbacks won't jeopardize your basic financial stability or force you to sell assets. It's about establishing a reliable process that functions well during normal months and withstands chaotic times, rather than trying to predict market movements. Real progress comes from synchronizing your saving, spending, and investing with your time horizons instead of reacting impulsively to news headlines. The save-invest continuum illustrates when cash is the optimal tool and when it's beneficial to let investments shoulder the heavier load. Addressing spending inflation through the 2x rule teaches how to embrace upgrades while simultaneously increasing your investment contributions. Dollar cost averaging highlights that sticking to a regular purchasing schedule is more effective than waiting for dips or chasing uncertain outcomes. Diversification demonstrates how index funds can capture unique market opportunities while providing protection against risks from individual companies. Guidance on debt reveals how borrowing can be advantageous when it effectively reduces risk or provides returns greater than its cost. Each element plays a vital role in creating a life where financial goals progress without the burden of constant decision-making fatigue. Begin with one automated purchase, one intentional spending guideline, and one debt decision evaluated based on risk and return. Subscribe for more actionable financial frameworks that help you maintain progress, even when motivation and market conditions fluctuate.